Hello and welcome. In this section you will learn how you can avoid some of the biggest risks in trading. You will learn which dangers are linked to so-called trading gaps, why you should take great care in choosing your position size, how you can control your risk the right way, and you will also discover why you are actually the biggest enemy in your trading. Let's start with one of the biggest dangers in trading, the so-called gap. Gaps occur when a commodity, an index, or a stock doesn't open in the morning at the closing level of the previous trading session. In other words, it opens with a price gap. In extreme cases, the price of a trading instrument can change in the amount several percent overnight, even though the instrument has not been traded. The most dangerous thing about a trading gap is the fact that typical protective measures, such as stop-loss orders for example, are effectless. That is because the stop-loss order will only be executed at a very bad price after the gap has occurred. Let's look at an example. You have entered a long position and placed a stop at 95 euros. In the evening, the stock closes at 96 euros. After the trading session, there is a news report concerning your stock. So opening price next morning is 93 euros. This is a trading gap of 3 euros because the stock opens 3 euros lower than the previous closing price. Your stop order will be triggered because the price is lower than 95 euros. But your position will be closed at 93 euros and not at 95 euros as planned. So your additional loss will be 2 euros per share. You can minimize that risk by keeping an eye on the respective trading sessions and by being aware at which times individual instruments actually trade. You can trade shares and indices during the same day and thereby circumvent the risk of any trading gaps. Currencies are trading non-stop from Sunday till Friday, so you can keep your position for an entire week without the risk of being caught in a gap. Whenever you hold a position overnight, it makes sense to take care of two things. First, you should count in the risk of a gap and adjust your calculation accordingly. I recommend that you are prepared for a gap approximately the size of the volatility of an average trading day. Also, you should always keep a close eye on the news of the particular instrument that you are trading. Are there any reports or disclosures that could surprise the market? Are there any quarterly reports, merger talks, or product news, for example? In general, and for most liquid instruments, trading gaps are not that big that they pose a problem for your trading. However, you should be well prepared nonetheless. Now, let's discuss another risk in trading: leverage. Anticipating fast and big profits, many traders enter a position size which is simply too big in relation to their account. If you're trading the DAX contract, for example, you can leverage your own capital with a factor of 100. If you fully leverage your own money to that extent, however, all it takes is a 1% move in the instrument traded to annihilate your account. Always be mindful of that. Basically, you can always leverage as high as you want, as long as you have enough money to back up your position. A professional trader will always adjust his position size to his free equity. As part of a professional trading strategy, it is always meaningful to calculate your risk in such a manner that you can tolerate a series of losses without wiping out your trading account. Always consider that risk and reward are closely linked to each other. The bigger the opportunity, the bigger the risk. And now, let's talk about a third aspect that we should consider. Another danger arises whenever we don't take enough care in limiting our risk. Even a relatively small position with little leverage can become very expensive if you don't cut your losses. You should always think in advance about your limit of tolerance. Define how much money you are prepared to lose and how much profit you expect in return. It is a good rule of thumb that you should never risk more than half of what you expect to earn on your trade. Let me give you an example. If a stock is quoting at 10 euros and your price target is 12 euros, it might make sense to place a stop order at 9 euros. The opportunity is twice as high as your risk. Such a trading strategy will be profitable even though a majority of individual trades may lose. Professional traders refer to the so-called risk-reward ratio. It is important that you stick to your strategy and do not fool yourself by holding onto your positions longer than you originally intended to by ignoring your stop levels. And we will discuss the fourth and most important danger in this video. The biggest obstacle in your trading success is actually yourself. Especially as beginners, many traders are sitting in front of their trading screens and watch their money become less and less, only because of their hope that their position will make a turn and become profitable. Once you rely on hope, you will no longer be objective in the evaluation of your trading. You will watch out for confirmation that the market will turn in your favor. When it comes to emotions, trading in the financial markets can be very similar to riding a roller coaster. As people, we are programmed to listen to our intuition, and that can lead to mistakes. Therefore, it is important to never let your feelings take control. One of your first responsibilities as a trader is to develop methods to spare you from damages due to emotional decisions. Instruments and procedures such as well-defined money and risk management, as well as keeping a trading journal, will assist you in making rational choices. Especially helpful is a trading mentor or a partner who will question and guide you in your decisions. This will also help you to follow your own rules. Because this is your biggest danger, that you will leave the path of following your own rules. So in this section you have discovered how to prepare for trading gaps, why you should always choose your position size with great care, how to control your risk effectively, and you have learned how to stay in control of your trading. But we haven't talked about the greatest risk in trading yet. Usually, trading on margin comes with an additional payment liability. If you or your broker are not able to close your position quickly enough, in the case you suffer big losses, your account could actually become negative, and this could result in a call for additional cover. However, our safety systems are precise enough to ensure that all positions will be closed automatically and fast enough if losses spin out of control. Therefore, we are able to completely exempt you from any additional payment liabilities. Even in extreme cases, you can never lose more than you have on your account.